Thank you, Mike. Hello, everybody, and welcome to today's session. For those of you who know me, hello. For everybody who doesn't, I'm Mike Dalton, a representative for Momentum Harmony Funds. Just a thank you for joining us today, and a quick introduction to our panelists. We have Andrew Hardy, who is the Director for Investment Management with Momentum. He's also the Head Portfolio Manager for the Harmony range of funds. He's worked with and been with Momentum now in London for approximately or slightly over 15 years, so super experienced. And then on the other hand, we have Glyn Owen, who is Director of Investments for Momentum, also in the London office. Glyn is our absolute go-to person, and his experience is absolutely phenomenal. Glyn has worked actively in the City of London since 1973, so his knowledge and experience is absolutely superb, and we're delighted to be able to have them both here today to pass on their knowledge and experience and information, market point of view with you today. So I'd like to hand over to Glyn Owen to kick us off, please.
Right, thanks very much indeed. Appreciate that. I wish I was in the City of London at the moment, Mike, but we're still in this wretched lockdown here, as you all know. So we're still at home in the countryside. It could be worse, I suppose, but it's long for the day when we can all get back into the office and to see clients face to face. Anyway, very nice to be with you today. Thank you for joining us. I thought what I'd do is start off by having a quick review of what's been going on in markets in recent months, looking at the first quarter of this year, and this 5-month period. It happens to be just about 5 months, almost to the day, since with the last Hansard webinar, which hopefully some of you will have listened to back in early November, and that, if you recall, was an absolutely key turning point in this pandemic. Because it was very early in November that Pfizer came out with the vaccine news. We just call it now the vaccine news, which just really transformed the prospects for getting through this pandemic successfully, and is already plainly doing so in those countries, notably here in the UK and also in the US, which is successfully and rapidly rolling out the vaccine. So looking at what markets have done over those 5 months since early November, there's been a phenomenal rise in equity markets. And of course, then if you look at the 12-month numbers, that encapsulates more or less the whole of this bull market that we're currently in, because that very short, sharp bear market that we experienced back in March ended right at the end of March. So there's been terrific returns over that period, but these really big returns in this short 5-month period. Intriguingly, within that, the US market, which had been leading the way, has slightly underperformed, still delivered a 20% plus return. Those markets which had lagged quite a lot, and you can see there Europe and Japan are notable ones there, have performed rather better. The UK has definitely benefited from the Brexit deal that was done on Christmas Eve, getting a deal with the EU, a free trade deal that people thought was beyond the grasp of the UK, was done. I think that was very positive. We've seen sterling rally quite a lot since then, and the UK market has recovered quite a long way. Still an underperformer over 12 months, and we think still a very interesting market. Andrew will talk about that a bit later on, but we like that area a lot. And then China is worth noting. China was the first country into this pandemic, the first out. They successfully contained it. The economy slumped initially, of course, like every major economy slumped when this pandemic hit. But China recovered very quickly indeed. Was a big performer last year, but it's tailed off in recent months and been quite a big underperformer, partly because they have just been tightening policy a little bit because of some excesses building up in their system. And we'll chat about that a bit later on. But China's a very big part of the emerging market universe. It's about 40% of it. So that's had an impact on emerging markets in recent months. But the really big picture of recent months is the difference in returns between equities and bonds. What the vaccine news did was give people confidence that we were going to get out of this pandemic, that the slump that we were in economically was going to recover pretty rapidly, and we get a return to really high levels of growth. And I'll chat about that in a second. What that meant is that yields on bonds started to go up. So you had negative capital returns, and of course equities responded very positively indeed, which we've seen in the first quarter of this year as well. These are figures to the end of March this year. But the difference in returns between bonds and equities over this period is really very marked indeed. The world's greatest safe haven investments, US Treasuries, had one of their worst quarters in decades, down 4.6%. The long dated, the 30-year US Treasury was down 16% in that period. It's the worst single quarter for that particular instrument in 40 years, when the big bull market in bonds first started. So this is a very, very meaningful moment here where bond markets have sold off and underperformed dramatically. Interestingly, TIPS Treasury inflation protected securities, which protect both the capital and the interest paid on those bonds against inflation, have actually performed much better than nominal bonds, which is the line above, and over 12 months have done really rather well. And that's because while inflation expectations slumped in the first wave of the pandemic, when the economy really went into a very deep recession, inflation expectations have picked up quite a lot, and I'm going to chat about that in a few minutes because that's really very important. But that's why these inflation-protected bonds have performed so well, and has credit bonds over the year and indeed over 5 months, high-yield bonds have done very well. It's worth noting two things. One, the fact that corporate bonds, both investment grade and high yield, have outperformed treasuries means that the yield spread between those two areas has narrowed quite a lot. So in other words, they've become somewhat more expensive, corporate bonds relative to treasuries. The other thing is just the important thing within our portfolios, which you'll refer to, we've been positioned effectively in inflation-linked bonds and in corporate bonds, high-yield bonds in particular, over the course of the past 12 months. We've seen that as the area to be in. But overall, we still find bond markets somewhat expensive, and I'll explain why in due course. But this has been a really meaningful period for broad asset classes here. And we'll chat about what's happened within asset classes, but there's also been a rotation out of growth stocks into value. And we'll explain that in a bit more detail. So that's sort of where we're at today. It's been a very good period for investors. We've been positioned overweight equities, underweight bonds, in the right area as a bonds. So we've enjoyed, in terms of performance terms, these past few months. But looking now at the outlook on this next slide, we're very confident that the world is on the cusp of an economic boom. The vaccine news has given us the way out of this boom. It's worth bearing in mind too that the recession caused by the pandemic has not resulted in any widespread sort of destruction of capital. The fabric of the global economy is still much intact. It's an unusual recession. It was very short and sharp, but it's not left any capital destruction or any destruction of the labour market. We're ready to recover very quickly, and the vaccine rollout has given us all, both as individuals and businesses, much greater confidence, and you can see that in the confidence indicators around the world. And already, certainly in the US and UK, which have been, as I mentioned earlier, very successful in rolling out vaccines, already we're seeing some pickup in economic activity. But we do feel that as these lockdowns ease further, which vaccines will allow us to do, of course, exactly what we're doing here in the UK at the moment, there's going to be a big release of pent-up demand. And to give you some idea of the scale of that, in the US economy, the biggest economy in the world, it's about 22% of the world economy, the excess savings built up through the pandemic, people have been, the vast majority of people have kept their jobs, still working from home, not spending very much money, built up excess savings of about $170 billion. That's 1.7 trillion dollars is about 7% of US national income. Now, not all of that necessarily will get spent. JP Morgan in their results yesterday were talking about people saving rather more, but even a half getting spent will have a really big impact on growth in the US economy. Exactly the same things that have happened here in the UK and in due course in Europe, as and when they get their vaccine act together, which hasn't been terribly successful to date, as you will all know. So we're going to get this release of pent-up demand, and we're already seeing some signs of this acceleration in growth. On top of that, what we do know is that monetary policy, which has been extremely loose, central banks right around the world poured a huge amount of money into the system, liquidity into the system, buying bonds, cutting interest rates, and all the central banks, most importantly the Federal Reserve, the most important in the world, of course, have made it very clear that they're going to continue to maintain this ultra loose policy. So the Fed is saying they're not going to raise interest rates from the current more or less zero levels until the end of 2023 at the earliest, and they're going to continue to buy assets, to buy government bonds at the rate of $120 billion a month. I mean, over $1 trillion a year. So huge amounts of liquidity being pumped in. And the fact is that financial conditions remain easier today than they have been for many years. So that's very important. It's going to continue to support economic activity. Then the other big thing is what's going on with fiscal spending. There was a huge amount of money spent by governments to support economies through the worst of the pandemic. And although some of that will be eased back as we come through the recession, as we are now doing, it's quite clear that there's going to be no return to the fiscal austerity that prevailed in the decade after the global financial crisis in 2008. And that held back growth quite a lot. Quite the reverse. You've all seen what Biden has done since he's become president. And it was very important, incidentally, that he won those 2 Senate seats in Georgia in January. That gave him the freedom, the Senate control to push through this fiscal package of $1.9 trillion, got it through very successfully. Most of that money is being handed out in freebies to people, $1,400 checks, increased unemployment benefits. It's money that's going to flow into the economy almost immediately. And again, that represents 9% of national income. So you combine that with the release of pent-up demand, and nobody should be surprised that everybody around the world is raising their forecasts for US GDP growth this year and next. The Fed, pretty good body to turn to for this sort of thing, has just raised their forecast for growth this year to 6.5%. It could well be that over the next couple of years, the US economy is going to grow by somewhere between 10 and 12% in aggregate. Absolutely phenomenal performance. The UK is going to be similar. Eurozone will follow in due course, somewhat more subdued, and they're not spending the same amount of fiscal money there, and they've been slow rolling out the vaccine, but it will recover nevertheless. So we are really in for a boom, and there's no doubt the corporate profits are going to respond. The consensus earnings estimates for the S&P 500 for this year are about 40% growth, 40 that is. So this is phenomenal stuff that we're seeing, a lot to look forward to. And the other important points there that I mentioned quickly on this slide, the other headwinds that we had a few months ago about the US presidency, they're clearly behind us. There was Biden's success, I think, has calmed things down in the US. We've now got a more predictable president, and we can see that he's pushing through some big spending packages, some big changes there. And incidentally, on top of the 1.9 trillion he's just spent, there's another 2.3 billion dollars coming later this year for infrastructure and climate change and so on and so forth. So that's been a big important change there. And then Brexit, the UK successfully concluded that deal with the EU on Christmas Eve last year, and that's really put behind us the worst of the Brexit fears that were impacting on the UK. It was never a systemic issue, incidentally, the Brexit issue, but it certainly held back confidence in the UK market. Had been underperforming for really the whole of the 4 or 5 years since the referendum in 2016, and now we're beginning to see the UK, as I mentioned earlier, starting to outperform again from pretty low levels. So we're pretty pleased about that. There are a few teething problems as the Brexit deal settles down. You will have no doubt read about quite a few of them in January. Difficulties in getting exports through into the EU. I can tell you that in February, UK exports to the EU increased by 47% on January levels, returned to somewhere near normal, not quite, but getting there. And this nightmare of paperwork is being sorted out. I'm quite sure technology will overtake that in due course. So all those uncertainties and issues are behind us. So adding all of that together, we think, exactly as we said back in November, we think risk assets are going to move higher. Equities are going to move higher. We think equities will drive returns. Probably some change in leadership, as we're seeing with value stocks doing better, and we'll chat about that in more detail when Andrew comes on. But we certainly are positioned to participate in this further rise in equity markets, driven by this huge liquidity that we've got around, and this really very, very constructive economic environment that we're in. Bond markets, on the other hand, do have some headwinds, and I'll chat about that on the next slide, which talks about the risks, because of course in this business there's never a situation where there are no risks ahead, and there's some pretty significant risks that we must be aware of, which we certainly think about very carefully when we are constructing our portfolios. The first, of course, is the obvious one: third waves of the virus, running through obviously Brazil at the moment, which is really devastating. We're seeing some damage in India too. Europe is still struggling with lockdowns, and we can't rule it out at any stage. Of course, the mutations could spread globally, so we're alert to that. But there's no doubt that as vaccines roll out successfully, as we're seeing in the UK here, then it is going to help with all of this, and I think it will give us the way out completely. But it does mean the whole world having the vaccines, and that's going to take some time. So we're aware of that. Long-term scarring is a bit of an issue. People talked about it a lot when we first went into this pandemic. I'm not overly worried about that. I think very few businesses have actually been forced to close down as a result of the pandemic. And as I was saying earlier, there's going to be a big spending boom ahead. So the hospitality industry, tourism is going to recover pretty well. Some sectors, yes, there's going to take some time, but there's been no real destruction of the capital infrastructure of economies. So I'm not overly worried about that. The next point is more significant, and it's the one big thing that we focused mostly on in terms of risk this year, which is inflation. Inflation has been very low since the financial crisis. Global growth has been pretty low, as you know, pretty subdued. And inflation has really been below the Fed's 2% target through most of the post-financial crisis period. It fell even further when we hit the pandemic recession, but we are now seeing inflation picking up, and it's quite clear that because of the base effect alone, remember a year ago inflation was running into negative territory for a few months, the base effect alone means that inflation is going to start moving up, the Fed has made it very clear that it views that move as transitory. So it's not going to do anything about it. They don't see it as a persistent move in inflation. Now, they may well be right. We don't know, but they may well be right. But the concern is that if inflation moves up to, let's say 3.5%, and incidentally, the consumer price index in the US announced yesterday went from 1.7% in February to 2.6% year on year in March. So we are now seeing this pickup in inflation. If it goes up quite a bit further, it could cause the market to wobble a bit, and indeed it could even cause the Fed to begin to talk about tightening policy to remove some of that asset purchases they're doing. And if you remember back in 2013-14, it was the Fed that triggered this taper tantrum that we all talk about, quite a sharp rise in bond yields at that stage. Could see the same again. So we're up for that. It's not our view, but it's certainly a risk. Longer term, there's no doubt that we face the problem of an overhang of government debt. Huge amounts of money have been spent by governments to support us all through the pandemic. It's not today's problem, but sooner or later it's going to be paid down, and it will be a headwind to growth in due course, but it really isn't this year's problem. More importantly, this year, I think we're going to see tighter regulation of big tech. There's no doubt that Biden is intent on that. And more recently, we've seen China under President Xi tighten and clamp down on the internet entrepreneurs in China, and that's something else that we're watching out for. US-China relationships, well, I don't think anybody should feel that with Trump out of the way, they're going to get a lot better. It's obvious they're not. And maybe the focus will move away from trade wars, which I think it will, towards things like human rights, cybersecurity, intellectual property, and those sorts of things. But I think it's still something as we go through the next 12 months. And the other thing that we're conscious of is that everybody's seen this boom coming, and markets have moved up a fair bit. So markets are discounting some of this recovery, although I don't think by any means all. It's only when we really get into it that people will get confident about just how much growth and how much rising corporate profits we're going to get. But also valuations in some asset classes are high. In particular, the asset classes which have led equity markets in the past, well, not just year, but particularly the past year, the pandemic winners, the big tech stocks, which Andrew will talk about in due course. So there are some pretty high valuations there. Hence, that's why I say I think as we go through this year, we're going to see some rotation away from the pandemic winners towards those companies that did very badly, the value stocks, and are now going to get an absolute boom in profitability. But the key thing here is that there is going to be some volatility. We've had a pretty calm period without too much volatility for a number of months now. We had that little bit of a blip in February, March when bond yields were rising. I'll come back to that. But we do see a bit of volatility through this year. But nevertheless, equity markets making more progress, participating fully in this economic boom to come. So stay invested, as we said 5 months ago, but carefully diversify. Having said all of that, I'll just go into a little bit more detail on some of the points I've made there, and really focusing on the bigger issues. First of all, I mentioned this huge monetary and fiscal response of governments around the world to the crisis. What this chart shows is, as a percentage of GDP, the fiscal stimulus that each country, these major countries or regions provided as a percent of GDP on the vertical axis, and then the stimulus from the central bank in terms of asset purchases, so the size of those central bank balance sheets as a percent of GDP. The red blobs, of course, are all the virus ones. We thought that there was a lot being done to support economies in the financial crisis, which are those blue blobs on the left there. But the numbers now dwarf anything we saw in the financial crisis. Absolutely dwarf it. The amount of money being spent by governments in the US and UK, well over 10% of GDP. The numbers we've seen from Biden now, this $1.9 trillion package, that clearly adds to that. Yes, the economic growth will definitely help in cutting back on some of those deficits, but as I mentioned earlier, absolutely no sense of return to fiscal austerity. It's just not going to happen. Going to be continued large fiscal spending, which will support growth, and the same with the size of these balance sheets. There's all of these big central banks are committed to maintaining either continuing asset purchases, or even in the case of the European Central Bank, accelerating them, as they decided to do a few weeks ago in the face of the further lockdowns across Europe because of the poor vaccine rollout. So we can be certain that this largesse, both fiscal and monetary, is going to continue for some time ahead. The only time that we've seen bigger fiscal spending going on is in world wars, incidentally. So this is really unprecedented. Give me one second. Let me just get rid of that. Bear with me. Just going on now to something I mentioned earlier. Confidence has picked up, and it's led to these huge rises in leading indicators across the major economies of the world. We look at these numbers pretty carefully. They are widely used leading indicators. I'm showing here the manufacturing purchasing managers indices. Over the years, these have proved to be a very good lead indicator of where the global economy is going to go. Above 50 means you're in expansionary territory. Below 50, you're in recession territory. And guess what? In the pandemic recession, let's call it, when the pandemic first hit, the economy slumped into a very, very severe recession. If I showed services industries here, they'd be even worse in that period. But there's been a remarkable recovery. All these numbers are now above 50, as you can see. China is the only one at the moment slowing down because, as I mentioned earlier, they are slightly tightening policy, but they're still in expansionary territory. China's still going to have a big year for growth. Nothing like the sort of 10% plus years that it's had historically on a consistent basis, but it's still going to grow pretty significantly. But the rest of the world, the developed world, you can see there's been a huge acceleration in these indices, in some cases to record levels. So you can say with some confidence this is going to feed through into activity levels and GDP growth. Hence, everybody's revising up their forecasts and everybody looking forward to a big surge in corporate profits. So we're confident about that. On the next slide, what I show here is one of the implications of what has been happening, which is the beginnings of this recovery going on in economies, and we're seeing some evidence of that in the US and UK in particular, Eurozone to some extent. We're seeing a rise in commodity prices. Now, they did fall sharply during the recession. You remember oil in particular, the brown line there. Well, for a very brief period, it fell into negative territory. That was clearly not sustainable, but it got to about $20 per barrel, trading now $60 a barrel. So it's tripled in price over the past 12 months. That's now feeding through into the consumer price index that I referred to earlier. It's a significant component of that. Then the blue line, copper, is a very good indicator of activity levels in the global economy, very sensitive to the global economy. Fell sharply in the pandemic. It's pretty much doubled since then. Same with the iron ore price. Now, this is showing that there's a shortage of these materials. There's quite a lot of activity going on. It's certainly pointing to higher levels of producer prices coming through, and that will feed through into consumer prices in due course. And then on to the next slide, which is what inflation has been doing. And I'm looking at a range of sort of different inflation indicators here. Inflation fell very sharply in the pandemic, the recession, for those few weeks or months, and in fact, it fell into negative territory in some cases, inflation. But we've seen quite a sharp pickup here. What we're showing, the grey line there, is US consumer price inflation. The number shown here is actually for February, as I mentioned earlier. There was a number out yesterday for March, which took the US CPI to 2.6%. So that's getting back up to the highest levels for quite a number of years there, for the best part of a decade, and almost certainly going higher. Because we've seen that big surge in commodity prices, and secondly, this US producer price index, as you can see there, has risen very sharply off the lows. And in fact, the most recent numbers out there, which came out after this chart was produced, show that index is now running at 4.2% year on year. So really rather high. Again, that's going to feed through to inflation. But the big question is this going to be a temporary thing, or is it persistent? We don't know that. The Fed focuses most importantly on the US core personal consumption expenditure, which strips out the volatile components of energy and food. And you can see that's been pretty stable. It's picked up a little bit, but the core levels are not nearly as high as the broader indices. And the blue line there is a very important line to look at. There's something else the Fed focuses on, which is the market's expectations of inflation. It's a five-year forward inflation index, which shows you what the market thinks inflation will be 5 years out for the ensuing 5 years. And yes, it's picked up quite a long way, but it's only got back to the levels that were prevailing for a number of years, quite a number of years, before the pandemic hit. So it's not actually a great worry. It's certainly just over 2%. And the Fed has made it very clear that it's quite content to live with inflation a little bit higher than its target range of 2%. Because one of the big changes the Fed made to its policy setting agenda back at the end of last year was to move to an average inflation target of 2% over a cycle, which means it can run hot. It can allow the economy to run hot for a period of time to ensure that inflation reaches this 2% level and is sustained there. So no great worries at the moment, but it's something we are definitely watching out for, because rising inflation has a big impact, of course, on bond yields. And we're going to chat about that on this next slide, which shows you the US Treasury 10-year bond yield. So the yield on the bond is the green line. You see that fell back in, well, it got to a low between March and August of about 0.5%, an all-time low. I mean, 0.5% pays you nothing for owning a bond for 10 years and well below inflation rates, of course. That has picked up quite a bit to around about 1.7% today, but keep it in perspective, it's still very low by any historical standard. So but a big rise in interest rates, but only to levels which are pretty much at the low ends of those that we've seen for the last decade. The brown line there, the 10-year break-even yield, is the market's expectation of inflation 10 years out, not dissimilar to the number we looked at on the previous slide for 5-year inflation 5 years out, about 2.3%. Again, it's moved up a long way, but it's only got back up to the level that was prevailing for, well, actually, almost all of the post-financial crisis period and the decade or so before that. So it's not yet alarming, but we're watching out for it. And then importantly, real yields, that blue line, so in other words, the yield on the Treasury bond, less inflation, that's been in negative territory for a period here. I mean, got down to more than minus 1%. So you're losing money in real terms for owning these bonds. It's picked up significantly, and most of that move took place in February and March, which is when we had the wobble in growth stocks. Because of course the 10-year bond yield is arguably the world's discount rate, and if you discount a long stream of earnings by a higher yield than the one prevailing beforehand, you're going to get a lower price, and which is exactly what happened with share prices in the growth sector for a period there. I think the FANGs index, I think from memory, fell by about 17% in that short period. Recovered quite a lot since then. The point about this is that real yields have picked up, and they may well pick up further. But look at where they're at. They're still in negative territory. So minus 60 basis points. So this is by no means representing any sort of a great monetary tightening at the moment. So we're not alarmed by it, but we're watching out for any further unexpected surge in inflation, because that would almost certainly push the yield on the bonds significantly higher. We think it will go higher in this cycle. It's not an attractive entry level for us, but it could cause wobbles in markets when it does happen. So hence my comment earlier that our biggest concern this year is about what happens to inflation. And like the Fed, we don't think it will become persistent, but it's something we're watching out for. Then quickly summing up so Andrew can get his time on, I'm going to flick through this slide in the interest of time, because I've really covered most of this, and onto the next couple of slides very quickly. I mentioned earlier that there's been a big style rotation in markets. These lines show world value stocks versus growth stocks. Until about January, February time, both were moving in tandem post the vaccine news. It's fair to say that growth has been massively outperforming value for most of the past decade. Andrew will talk about that. There has been this rotation into value. We think it's got a long way to go, and we'll come on to talk about that in more detail. There's some real opportunities here, we feel. And then finally, just on currencies, the big consensus trade going into 2021 was the fact the US dollar was going to stay weak, and it had a weak 2020. Well, guess what happens when everybody's got a consensus view? It goes the other way. The dollar, as I think you know, has actually been quite strong this year on a trade-weighted basis, up almost 4%. There's very few currencies. The only major currency that's gone up against the dollar this year is the pound. I explained earlier why the pound's been going up. It's the Brexit deal, and may well have something further to go. And I think most of that's now discounted in sterling. On the right-hand side, gold was certainly been hit by this rise in real rates and a strong dollar. The Brazilian real, I think you probably all will know why that's had a tough time with the way the pandemic's been going there. The two great safe haven currencies, the yen and the Swiss franc, have come down quite a long way, as has the euro. And it may well be that with this boom to come, particularly in the US economy, it's going to far outstrip anything in Europe and Japan, pull in capital, no doubt. Interest rates on US bonds are materially higher than on European or Japanese bonds. I think you might well see the dollar going up over the course of the next few months. Still, it's not a big position we take on currencies, incidentally, but just in terms of sort of perceptions, it looks to us as if it may well have a bit of a tailwind behind it. But longer term, we do have some concerns about the dollar, the amount of debt there, the fiscal deficit being run, total government debt very high. And also the trade deficit that's being run there, so that will definitely be headwinds. So longer term, we would have some concerns, but importantly, I would emphasise big positions in currencies. The key thing for us is getting the asset class decision right, and then the underlying securities. So with that, I'm going to hand over to Andrew.
Thank you, Glyn. Hello, everyone. Thanks for joining us. Just a reminder, if you have any questions, then please do drop them in the Q&A box, and we'll pick them up at the end. So, as Glyn's articulated, we have a bullish view on the medium-term outlook for markets at the moment, and for equities in particular, and would, I guess, continue to suggest to clients, as we were on the last webinars, suggest stay invested across a diversified range of stocks. That's been a winning strategy for many years. Global markets have been strong, delivering annualized returns of around 10% per annum for the last 10 years, obviously with volatility along the way. But what I'd like to focus on now is the nuance and what's changing beneath the surface. The outlook articulated by Glyn, I think, translates into a very different market environment going forward from what we've been used to over the last few years, and really requires us as investors and advisors to consider on whether we're appropriately positioning clients for this environment. So first up, and one of the most important points to highlight that Glyn's alluded to, is markets have been very narrowly driven for many years now. It was very much the case last year and has been for a good 5 to 10 years or so. But we think this will start to broaden out much more over the course of the coming months and years. So a bias towards the past winners in portfolios will probably lead to underperformance, in our opinion. This chart shows you the total market cap for an expanded version of the so-called FANGs index. This one includes 6 stocks: Facebook, Apple, Amazon, Netflix, Alphabet, and Microsoft, which together have an incredible market capitalization of what, $8 trillion or so. That's bigger than the entire UK stock market. It's bigger than Japan's annual GDP, just to put that into context. So phenomenal across these. And on the right-hand side scale, you see the percentage that they make up in the US market index, not far off 20%. It's come off a little bit lately, but still very, very concentrated, and much more so concentrated than most times in history. And indeed, as a result of this, the US has also outperformed a lot as well. And if you look at the MSCI World Index, that's now, the US constitutes about 2/3 of that, which is very much a high level, much higher than it has been for many, many years. And these stocks really have benefited from many of the trends of the last few years. Low rates, they're effectively longer duration businesses. The value is further out because they're expected to grow for such a long period. So their valuation tends to benefit as interest rates are low or go lower. And indeed, they've been operating in a fairly loose regulatory environment. So you're at this point now, and valuations are very high at this point. And there's question marks over the outlook for interest rates from here, and definitely around the regulation side of things as well. We know that's increasing around these businesses. Antitrust type rules coming in, more pressure on taxing them appropriately, etc. So the point to recognize is that investing in a passive strategy that tracks the US market or global markets, you're introducing quite a lot of concentration risk within that. But on the flip side, I'd say this is a very good opportunity for active managers going forward. So speaking to that side of things, this chart highlights the performance of active managers within the Morningstar Global Equity Peer Group over the last 5 years. So each bar represents the 5-year annualized return of one of the 1,300 funds within that universe. The red bars represent managers that are in the growth grouping within there. So strategies that Morningstar categorizes as being more growth orientated, so likely to have more in those FANGs, tech stocks, high growth businesses and the like. And what's clearly apparent here is that growth strategies have been outperforming for a long time. The average growth strategy has outperformed the index by 1% or so per annum, whereas the median manager is some 2.5% per annum behind the index. So these growth managers have on average benefited from that trend we saw on the previous slide. The implication is that, well, what we see is that clients are increasingly concentrated into the strategies that have been winning, into growth strategies. You know, the ones that have been loaded up on the FANGs and the like, they're easy to like, you know, easy to understand. We're very familiar with them. The growth trajectory is very clear and easy to see them continuing to grow. But the key point, of course, is that valuation matters and has a huge bearing on future returns. And at this point, there's a huge amount of good news already discounted in prices which means future returns may not be anywhere near as good as past returns. On this next slide, we see the same thing, but over a 5-month period. So this coincides with going back to the beginning of November, when we had the first positive vaccine news, so-called Vaccine Monday. And that single day saw one of the biggest rotations ever in history from growth to value. So a massive rotation in what was being rewarded in terms of market factors. A biggest rotation on record ever, pretty much on that side of things, or at least on many measures in decades. Over this period since then, all ships have been lifted, pretty much. All global equity strategies have performed very well. But on average, growth-orientated strategies have underperformed here. So you see here 17.7 is the median growth manager return over this period, some 4% behind the index. So a huge change from what we saw previously. Sorry, 4% behind the median manager, much more so behind the index. And on the flip side, at the top here, you've got many other strategies that have been delivering a much better return overall. And many of these within here are value-orientated strategies. Within our Harmony portfolios, we have a few holdings which are at the top end of this curve here, including one actually contrarious, which is right at the top over this period. So there's been a phenomenal opportunity to add additional value in client portfolios over this period. So the question here is now, could the next 5 years look like this? How long will this trend persist for? Scratching beneath the surface here, this chart shows you global sector returns for the MSCI World in dollar terms over that same 5-month period. So we see, the backdrop that Glyn explained in terms of the rebound in commodity prices, the increase in interest rates, etc. This general so-called reflation trade has been reflected in sector returns. So value-orientated, more cyclical sectors, more sensitive to the future path of the economy, have outperformed. So energy, financials, and the like have delivered phenomenal returns over this period. So call it 40% or so on financials compared to 10% or less for consumer staples and utilities. A 20% spread between financials and IT as well. But then if you scratch beneath the surface more as well, you see, you look at a Citigroup up 80% or so. That's 110% over this period, ahead of Zoom, which was obviously a big winner from the pandemic period. So we've seen a huge rotation at the sector level, at the value versus growth strategy level, and even more so at the individual stock level as well. We think these sectors here and many of the value-oriented stocks within there could continue to perform very well going forward, as they benefit from having higher earnings revisions, higher earnings growth going forward as the recovery trade continues, as economies continue to reopen. And then this is a slightly more complex chart, but it gives you a sense for, I think, how durable is that rebound opportunity? How much further has this value versus growth type trade got to run? On the left-hand side here, we're essentially looking at what is the value of value. So if you look at the global equity universe and categorize it into 5 quintiles, if you were to naively buy a basket of all the stocks in the cheapest 20% of the index, how cheap is that compared to the median for the index, the average? It's always by definition going to be a decent amount cheaper. But at this point here, what the blue line is showing you is that it's cheaper than it's ever been. There's a wider spread between the winners and the average than down to the cheapest quintile of the universe. And it's actually at its cheapest, it's the widest value spread since the tech bubble. Now, just taking a step back though, what is value investing? It's essentially buying a business for less than its intrinsic worth. It doesn't necessarily mean you're buying something low quality. It's just buying something cheap. Here we're measuring it by low price to book value, which is a widely accepted and representative of many other metrics, highly correlated with them. Alternatives would be high dividend yield or cash flow yield or low PE. Many of them, all these metrics would point you to the same sort of picture overall. And like I said, buying value is not buying low quality. I think a great example of this is Microsoft, which clearly, as I said, is now very much a market darling. It's in that kind of expanded FANG cohort Famang. It's been a big winner and a big beneficiary of the pandemic period as well, and has been firing on all cylinders for several years now. But wind back 10 years, and Microsoft was unloved. It was a value stock, a phenomenal business, throwing off a lot of cash. But the market's expectations for its future growth were pretty pessimistic overall. So on a PE ratio basis, it got down to about 10 times PE about 10 years ago. But then wind forward to today, and it's on 40 times or more, and has delivered massive growth along the way and huge cash flows as well. Shareholders who bought 10 years ago have been phenomenally rewarded over this period. And today, yes, there's clear value in the riskier parts of markets and the deep cyclicals and the like, but you don't have to take huge amounts of risk. It just means buying something that's less, more out of favor and less loved, where expectations are lower versus what's been working for much of last year is areas that have already done very well. And in those areas now, expectations are already pretty high, and it's hard to surprise too much to the upside from there. So the question is, could this be a turning point? The last time that the value spread got as wide as this was the tech bubble here, and that heralded in a period of huge outperformance for value, which you can see on the right-hand side here, which is a chart measuring the performance of a naive basket of low price to book stocks. The blue line is the cumulative return for that strategy. It's had massive outperformance over this 35-year period, and the yellow line is the rolling 10-year return. So back during the tech bubble period, value had a very, very bad run. It's the last time it was anywhere near as bad as this. But buying then was the right thing to do, and was very well rewarded for many years thereafter. Here, over the last 10 years, we've had an even worse period for value, and it now looks exceptionally cheap. We've started to see a turn. We think that could carry on for a long way from here. Like I showed on the previous slide, we've already had a huge divergence between value and growth. But in the scale of kind of what we've seen over the last 10 years and the extended underperformance for value, I think there's plenty of justification in believing that can carry on for longer. And then also, I'd say there's a world of opportunity beyond just the US market. Equities overall, we think are attractive at this point. This chart shows you the cyclically adjusted PE ratios of the major developed market equities. Cyclically adjusted means it's just using a multi-year average earnings figure for companies, which helps smooth out the effects of the cycle and smooth out what can otherwise be quite volatile valuations metrics. So here you see that most of these markets are kind of in line with their longer term history, with the exception of the US, which is nudging higher, albeit a lot of that is driven by the FANG stocks and the like. And if you strip them out, then actually a lot of the US market is not that expensive. But remember, as Glyn said, we've got 40% or so earnings growth expected in the US. So that's not in these numbers. These earnings are going to grow, and that's going to help bring down the valuation metrics. But like I said, the US is now 2/3 of the world index. It's a very large, broad, deep market. There's a lot of great investment potential there on the growth side and the value side as well. But on the face of it, if you look at other markets internationally, valuations are lower there. And there's a lot of reasons behind that, not least of all that the US has had this greater tech exposure within the index. But I think that that handicap that has held back the other markets in not having the big tech names and the like, and being more skewed towards cyclical areas, and for example, in the case of the UK, financials, mining companies, energy, etc., could flip from being a headwind, as it has been for many years, to actually being a tailwind going forward, and could support strong outperformance for these markets going forward. So we've had a very good period of returns for markets over the last year or so in the pandemic recovery period. A lot of people are worried that equities look expensive at this point, but I think there's valuations look reasonable, especially when you consider in the very low rate environment and the potential for further earnings growth, massive rebound really from here. So again, one of the conclusions, like I said before, it really has to be passive may not be the answer here, given that 2/3 of that is invested in the US. I think there's very good prospects for an actively managed approach to actually be rewarded more going forward than it has been in the past when markets have been more narrowly driven. And then another thing that we think you need to bear in mind is think about having a broad range of asset class exposures in your portfolios. I always say diversification is really the only free lunch out there. You can buy assets with similar expected returns, and if they're not perfectly correlated, then buy a few of those. You reduce your risk, you spread your bets, but you can still achieve the same outcome for clients. You need to be careful about it. It's not about just name diversification. You need to understand the underlying drivers and how they work in concert with each other. But done right, diversification is really valuable. And real assets, we think at this point, so referring to property and infrastructure in particular, are a great opportunity. Normally, these areas of the market are defensive and often outperform during recessions and the like, because they've got a steadier demand and longer term contracts, etc., just less economically exposed. But during the pandemic, they were harder hit than normal because we had a complete economic stop, of course. It made sense. They deserved to be punished for that reason. There was a lot more risk came in, a lot more lease risk, balance sheet risk, etc. with these companies. They were very hard hit. But despite the very good prospects for reopening of economies on a view from here, and actually a lot more resilient performance in operating performance for many of the companies in these areas, they've still very much lagged in the recovery. And at this point, this chart shows you can get very good yields on these assets, measured relative to equity markets or measured relative to corporate bonds in this case as well, yellow being equity and blue being corporate bonds, which we think is really attractive at this point, especially when you consider that dividends have been cut for many of these areas, many of these companies, and there's a good chance that they will be reinstated over the course of the coming year as economies start to recover. But also there's a huge amount of variation beneath the surface. You've had the big losers have been areas exposed to retail, offices, airports and the like. And on the other side, you've had big winners, data centers, renewable energy, etc. The pandemic has really been a seismic shift for many of these parts of the market. You know, the way we work between offices and home, the extent of business travel, the way we shop, have any changes that were in place already have really been accelerated, and they won't be entirely reversed, we don't think. So there's reasons for certain parts of these markets to be hard hit and to be discounted further, but markets have really penalized them fairly indiscriminately, and that's created opportunities, especially if you're active and selective within that. In many of these cases, they're prime property locations, if you choose carefully, and you can find good value there, or monopolistic infrastructure assets. And looking back over the very long term, they've been great stores of value in real inflation-adjusted terms. They've got pricing power. They've often got inflation-linked contracts. They give you steady cash flows, steady distributions. And in a very, very low rate world, that's really, really attractive. And especially if you start to worry a bit about inflation, because they can be more, not perfectly insulated, but more insulated than the general equity market or a lot of other sectors in a scenario of increasing inflation. So we think they're a great way to get exposure to the reopening trade, but also kind of hedge that longer term inflation risk that Glyn talked about. Within our portfolios, these areas represent 10 to 15% or so. We access them entirely through listed vehicles, which brings more volatility. They tend to trade more like equities at times, which is unfortunate during particular downturns, as was the case during the pandemic, because they give you less kind of diversification benefit or downside protection than owning the direct assets would. But owning a direct asset, that better downside protection is often illusory. It's a function of the lower liquidity. And the thing to recognize is if you go via the listed vehicle, as we do, then you don't create a liquidity mismatch in your portfolio. But also, because it's liquid, you can actually take advantage of that volatility and the greater downside. So we were able to buy into listed real estate and listed property in the depths of the crisis, rebalance portfolios, and actually buy in at these very, very deep discounts to NAV, which has been very accretive to performance in the rebound period, as that kind of mispricing and very negativity has been normalized away. And then another point I just want to make is we need to think very carefully about how you diversify portfolios, and what is your ballast, what is your downside protection element within portfolios. For many years, investors have naturally used government bonds as the ultimate diversifier. They still really fulfill that role, but as you can see here, they really can't provide anywhere near the same level of protection as they have done over previous decades. These charts go back many centuries, as long as is possible, really, for the 10-year government bond yield on the US, UK, Germany, and Japan. We're at or bouncing off all-time lows across all of these markets, and at those sort of levels, we're looking at 2% yields or less for locking up your money for 10 years in these cases. And while you need some ballast in portfolios to offset the risk that come from equities, bonds will really struggle to really give you anywhere near the same kind of negative correlation and downside protection in risk-off periods than they did before. Yes, they might be stable, but they can't appreciate like they have in the past because yields can only go so much lower, really. And even if they are stable, then it's a huge drag on portfolio returns. But then you also have to question, can prices be stable on a medium-term view in an environment of rising inflation and rising debt levels, with huge supply to come in years as governments need to refinance these massive deficits they're running? There is a genuine risk of something akin to a buyer's strike as supply increases and demand decreases. So that could really see yields move up quite sharply and actually lead to pretty significant capital losses. So the risks we see as being highly asymmetric and very much to the downside. You might make a little bit on a few years view, but you could lose quite a lot. So alternatively, within our portfolios, we're diversifying into other assets where we see slightly better value. So emerging market bonds is one example, or private debt, again through liquid vehicles, commodities, precious metals and the like, and also liquid alternatives like long-short strategies and the like. Essentially, really need to be thinking about being diversified within your diversifiers or your defensive allocations. Another big theme is ESG. It's really an inexorable trend, I would say, with so much greater thought going into it from clients, investment managers, regulators, and really accelerated integration across the board. Even central banks are now integrating it into their asset purchase programs, as of fairly recently. And there have been many events in recent years that have supported the growth in ESG. As we measure it here, we're looking at new flows into sustainable ESG funds and the like, which really took off during the pandemic period, but have been accelerating for a long time, and I think will continue to. The pandemic has been a bit of a catalyst. It certainly has survived that. But the biggest factor that's accelerating it now, and to keep an eye on, is the US President Biden's new environmental policies, including around the recently announced $2 trillion infrastructure bill. There's a clear commitment to cleaning up the economy and investing in clean energy here. And there's massive spending behind that. And that's a huge change from the previous administration. And I think that's similar to come for many years around the world. It will continue to accelerate. And that can be a risk in portfolios, but it can also be an opportunity. And I think ultimately it'll only become more and more important. And it goes way beyond just environmental policy. It's also the social side of things and the governance side of things. Businesses with the best long-term practices should continue to benefit. It requires a long time horizon, I'd say, to invest in a sustainable and responsible way. You need to look beyond maximizing short-term returns. But if you do that, then I think it'll be very much be rewarded over the long term. The range of outcomes now between a business that's doing well on the ESG front or one that's really doing very badly and underperforming has really widened as more and more money is put into strategies like this that really factor in ESG integration. And ultimately, it's not about a yes or a no, it's about a how do you integrate it. There's many different shades of ESG integration. And I think that we all need to educate ourselves and our clients more and decide on what our sustainability kind of compass looks like and what we want to achieve for ourselves and for our clients. And then ensure we're getting the right type of service from our service providers. And a key starting point, I think, is to look at the UNPRI. It's the United Nations Principles for Responsible Investment. It's really a global standard for best practice. Many managers have signed up for that in recent years and are racing to kind of integrate ESG into their approach. At Momentum, we've been signatories since 2006 and take that very seriously. But that's a key thing to look at in your manager if you really want to take ESG seriously and get a feel for how they are taking it seriously as a business in their client portfolios and the like. And then just summing up, these are the key changes and I'd say risks and opportunities that I've highlighted here. We've always advocated these conclusions on the right-hand side. So be selective. It speaks to really having actively managed portfolios in terms of the investments you choose, particularly on the equity side of things, and being able to adjust asset allocation along the way. It enables investors to take advantage of mispricing and volatility and achieve a higher return. But secondly, diversification is always a must as well, but it needs to be carefully done, as I was saying before. You need to understand the underlying drivers in portfolios and ensure there's really enough variation within a portfolio that's at the same time consistent with your outlook and central view. And thirdly, as Glyn said as well, stay invested, but think long term. Focusing on the short term returns is a surefire way to undermine long term performance. And if you do the first and second points right, then I think this staying invested part for clients becomes a lot easier. In conclusion, the opportunity set for investors we think is particularly good today, but the range of potential outcomes is also growing. There's no single easy solution from this list on the left-hand side here, but they all should help to go towards, I think, helping achieve client goals over the next 5 years or so, and delivering better performance than might otherwise be the case in this environment. The typical, I suppose, compliance disclosure of past performance is not an indicator of future returns really rings very true at the moment. There's a lot of risk in many of the best performing funds at the moment. The next 5 years we think are going to look very different from the last 5 years. So yeah, this list highlights really how different the environment could be going forward. We need to ensure client portfolios can remain resilient through this, or better yet, benefit from these shifts. And this really speaks to how we're positioning the Harmony portfolios at the moment. We've always very consistently had a style blend within portfolios, particularly within equities, and a very diverse asset allocation view as well. But I think more so than ever, that style diversification is really key and something to look for in any portfolio that you're running for clients. And asset class diversification, I think, is going to be much more important going forward than it maybe has been in the recent history. At that point, I'll conclude and we can move on to some questions.
Thank you very much, Andrew and Glyn. Very interesting and very interesting points that you've raised. If anybody has any questions, please put them in the Q&A box down the bottom and we'll get to them straight away. One of the questions that's come in, a very notable and interesting topic, is cryptocurrencies, and if you've any comment on Coinbase's yesterday's IPO and the possible outlook for cryptocurrency valuations moving forward.
Yeah, okay. Yeah, they've had a very successful IPO so far, very early days, but I suppose not surprising given the strength we've seen in cryptocurrencies for many years now. Bitcoin in particular, chief protagonist, has been very successful, nothing short of that. It's got a relatively short history overall in the context of financial markets, but is going from strength to strength. And the price appreciation that we've seen, particularly over the last year or so, brings it onto the radar of many more investors and attracts more attention. And the more it starts getting included in portfolios, the more the price goes up and the more people have to pay attention to it. We don't have any exposure at the moment to cryptocurrencies in the portfolios. We wouldn't rule it out at some point in the future. We've considered it along the way, but are of the view it's hard to fit into portfolios. It's very uncertain, and my personal view is it's very speculative at this point. Yes, there's a great chance that Bitcoin could go from strength to strength. There's also an equal chance that it could get displaced by another second, third, fourth cryptocurrency in the queue at the moment, or some new cryptocurrency or technology that comes along. Blockchain as a technology is very impressive and has a lot of application. And I think cryptocurrencies are here to stay, but it's very difficult to build any confidence in what might be the winner from here. It's still very nascent, largely a speculative asset class in that most people are not using it for transactions for the most part, and that's not where the value is at the moment. That could change going forward, but like I say, that's fundamentally speculative as to what the future might look like. And it's nothing like gold, where you've got centuries of evidence of the stored value and the ability to maintain real purchasing power. So yeah, hard to value, very hard to predict. Probably been a pretty significant beneficiary of the massive amounts of liquidity washing around markets at the moment, post-pandemic stimulus, etc. It's certainly risen in line with that to a large extent. So not surprising to see it performing very well in that environment. Many people see it as a bit of inflation hedge, and that makes some sense. But we do have exposure to similar sorts of assets, but we focus more on the more established areas: precious metals, gold, silver, etc., which we have exposure to in our portfolios.
With the recent the announcement from President Biden of tax increases both on a personal and corporate level, how do you see that impacting stock prices in the future?
So my initial view would be it's important. It's going to be a factor that markets are going to increasingly have to take into account over the coming next few years. It is probably an issue for another day, not for today, really. I think whilst it's going to have some influence on earnings trajectory for the market as a whole, and particularly for it's going to be quite varied across different sectors, I would say, in terms of how that might impact things. And indeed, the general tax level will significantly influence overall growth and the like to some extent. But the big picture today is we're on the cusp of this massive economic recovery and massive earnings recovery for corporations, and any adjustment that needs to be made for changes in tax rates or indeed valuations as a result of tax expectations are going to be very much dwarfed by the recovery that's coming and the variation across the market in terms of who are going to be the winners of that recovery and who's going to be a relatively lesser beneficiary. I'd say, like I said before, that there's a big risk on the tax side of things to many of the winners of the last 5-10 years or so, the FANGs and the like. They've been beneficiaries of low international tax rates, and there's a concerted global effort to address that and to increase the tax take there. So they're likely to be bigger losers than some of the other parts of the market in time. But like I say, probably not so much an issue for today from our point of view.
Mike, you're on mute.
Sorry, thank you.
Mike, can I just add one thing to Andrew on taxes there? But I fully concur with Andrew's point of view that it's not a big issue at the moment for markets, and it's going to take a while for Biden to get these tax increases through. They will come through later this year. The rising corporate tax is going for 28%. I don't think he'll get that through. He might get 25% through, something like that. That's going to be a bit of a headwind for corporates, just as the big tax cut that Trump put in place was a tailwind. But I don't think it's a train smash, as Andrew says. Intriguingly, on the personal side, it looks as if he's only going to increase taxes on the higher earners, and it's going to have very little impact on the overall economy. I don't think, quite frankly, because they're not the sort of people that's going to suddenly stop spending as a result of a 2 or 3% tax increase. As an aside, I was chatting to a friend of mine in York a few weeks ago, and he was saying that this combination of a federal tax increase to 37%, along with an increase in New York state taxes to 15%, 52% marginal tax rate, is becoming a real burden. The same in California, and explains why people like Elon Musk have moved to Austin, Texas, where state taxes are zero. Same with Florida. So it might result in some internal migration in the US of the upper end of guys. As we've discovered with this pandemic, you can work from anywhere these days, even Austin, Texas. So you never know. There might be some regional impacts within America. I don't think it's going to have a big impact in the aggregate economy.
Thank you, Glyn. You both mentioned on a number of occasions value stocks. There's a question here just asking if you can give some examples of value funds held within the Harmony range, please.
Yeah, sure. So within the Harmony range, we invest in a range of global and regional strategies, depending on which portfolio you look at. So in the US dollar portfolios, for example, we'll have some global strategies and some US focused ones. So just zooming in on those, on the global side of things, we use the one I mentioned that was number one on that 5-month chart that I showed you was Contrarius. They're a manager based in Windsor here in the UK. And then Robeco is another big one that we use on the more systematic side of things. Artisan have got a global value team based out of Chicago now, actually. That's one of our long-standing value managers. Hotchkiss & Wiley, California-based on the global side of things. Lyrical, based in New York. So they're and also a more historic one, Vulcan, based in Birmingham, Alabama. We go far and wide to find what we think are really the outstanding talents on a global basis. Many more I could talk to, but that's a few names to get you going.
Another question. Sorry, thank you for that. Another question just in. There's balanced and growth funds in US dollar and pound. Are there any plans or reasons for not having having the same in Europe?
Yeah, no, we are always responsive to where the demand is. I think that there's been less demand on average for a range of different European profiles. We're actually we're likely to make the European existing profile to be a growth one. It's currently kind of sitting between balanced and growth with its risk profile. We do have a cautious portfolio already, which has a euro hedged share class available. So once we've got a growth profile there, and we've already got the cautious one with a euro hedge share class, you can essentially mix the two to create any risk profile in between. So no immediate plans to expand beyond those at the moment, but if there's sufficient demand, then we're always happy to broaden out the range if it makes commercial sense.
Sure. There's a question from myself actually. With the well announced slowdown or lack of availability in semiconductors, whether it's cars or certainly electric vehicles, it's going to have an impact. Do you see that having a broader impact on across the market on people reliant on them?
I think the main impact for us to worry about as investors in financial markets is, like Glyn was alluding to, some of the PPI numbers, the inflation effect that shortages are having on input costs overall. So yeah, I mean it can create a bit of a bottleneck in terms of kind of delays of getting things to consumers or whatever it may be, but that then also creates excess demand versus supply and a bit of a spike in prices. So we've seen that across many different parts of the market due to the disruption from the pandemic. Shipping rates, for example, is another prime one where they've really blown out very significantly. I think tripled or so from where they were at a year or so ago, and that was expected to come down as economies start to normalize and everything. But we're not there yet. It's continuing. Things like the problems in the Suez Canal have also delayed any reset on that front. So yeah, there's bottlenecks. They'll sort themselves out over time. In the short term, probably just contributes to that view that inflation is likely to spike on a temporary basis.
Okay. Thank you very much. I don't see any questions coming in at the moment. I might just hand over to Mike Wrigley from Hansard to wrap up. Thank you, Andrew. Thank you, Glyn.